One of SoFi's biggest bears has just changed his tune on the company. He went from negative to positive just 3 weeks before earnings. And the best part is he's not even the only one. Multiple analysts this week have either upgraded or initiated SoFi, and it seems as though the sentiment is slowly shifting towards the positive right as we are about to head into Q1 earnings. Let's talk about it. If you're new to this series, on Friday, every Friday, I recap all the SoFi news that happened in this week. Subscribe to the channel for more deep dives on SoFi specifically. As usual for this series, we'll start off with the stock price action. Over this past week, SoFi closed up a whopping 9 cents over the past 5 days. The volume here has been absolutely flat. The stock has been trading between this $7 to $7.60 range. Earlier today, it closed off the week at $7.40. In fact, when you zoom out, SoFi is perfectly flat over the past month. It opened at $7.40 a month ago and it closed at $7.40 today. And even if you look at it from a monthly perspective, it's just been hovering in a 70 cents range. So it's very quiet action as we head into that earnings in about 3 weeks. In terms of the news, starting off on Monday, we got SoFi's response to the Robinhood credit card offering. SoFi boosted their credit card benefits by 10%. In a post on X, they highlighted that individuals who set up direct deposit with SoFi checking and savings will have unlimited 2.2% cashback rewards on all purchases and unlimited 3.3% on SoFi travel with no caps or limits. And obviously this move, just being in close proximity with Robinhood's announcement, is seen as a direct response to Robinhood's new 3% cashback offering that they announced just a week before. The second thing to consider is that this card is no fee, so from a business perspective, it's more sustainable, right? If you'll remember, SoFi's credit card business line is not profitable, and the company mentioned that they're actively investing millions of dollars to make that credit card offering more viable. As I mentioned in my previous video discussing the Robinhood credit card, more competition in this space is not only great for users because they get to see more benefits out of this card, but it also forces companies to innovate. So it's really good to see SoFi respond to Robinhood's offering because it shows that they can be competitive, but they're also doing it in a more sustainable way. They're not, breaking the bank essentially to go all in on the benefits. I mean, this is still a business after all, right? And around the same time on Monday, I also saw this email around the $100 referral bonus and a direct deposit bonus increasing from $300 to $400. I made a post around this saying that this seems like a combined push along with the credit cards to get some new members into that ecosystem. And the thing you have to keep in mind is that all of these things compound on each other, right? From a member's perspective, you have the MBA, you have these bonuses, you have better rates on cards, you have rewards and incentives. It seems as though SoFi is pushing fairly hard on getting new members, which is great because we know that they have profitability in the bag. They've guided to be sustainably profitable this year, and now it seems as though they have that added flexibility to also push for members, which I'm sure is going to be reflected well in upcoming earnings reports. And speaking of upcoming earnings reports, we did get confirmation this week of the Q1 earnings date being Monday, April 29th before the bell. That's about 15 trading days or so leading up to earnings from now. So in this video, I mainly want to talk about the analysts, but before I jump into that, I just very quickly want to cover the Cathie Wood purchases. Cathie Wood at ARK Invest bought SoFi 3 times this week on Monday, Tuesday, and Thursday, all in ARK F. On Monday, we saw a purchase of 171,000 shares, 125,000 shares on Tuesday, 166,000 shares on Thursday. At the time of this recording, I don't have the report yet for Friday, but I wouldn't be surprised to see another purchase again today. Usually she'll buy in batches. The last time I think it was a 9-day streak where every single trading day she bought for like 2 weeks in a row. And I mentioned in a post on X that the rate at which Cathie Wood has been purchasing SoFi is encouraging because she has over 15 million shares of SoFi across her different funds. And this is an 8x improvement on the amount of shares that they had just at the end of January. So February, March, essentially 2 months, 60 days, and she's increased her position by 12 or 13 million shares. In fact, SoFi broke into the top 10 positions for ARK F and is very quickly, if she keeps up at this pace, it'll very quickly break into the top 5. Now, with that out of the way, let's move on to the main story that I wanted to cover this week, which is analysts and the sentiment seeming to shift to the positive. On Tuesday, we got an upgrade to a buy rating on Zacks. On Wednesday, we got a $10 price target from Needham from the analyst Kyle Peterson, and this one in particular got the most media attention. I think partially because this is a new analyst that's just initiating a buy rating on SoFi. According to FactSet, there's about 18 analysts that now cover SoFi and only 4 of them have buy ratings. The majority of them, 10, have neutral ratings on the stock. And as a result of this $10 buy rating, there's been several publications this week that have just highlighted this point, and even Cramer talked about it on CNBC on Wednesday.
Let's get to Jim and stop trading.
The most popular stock on Mad Money is SoFi. And Needham comes out today with a piece saying, listen, $10 target, that things are getting better there. It's Anthony Noto. That's a great relief to people who were concerned that perhaps there was a convert that was done that issued a lot of stock and really crushed it. So maybe this is the comeback, I hope.
The analyst Kyle Peterson talked about the company's high growth lending business and the bank charter specifically, which he called efficient and sticky funding. And then, a surprise benefit, he also went further in depth on the company's technology platform in Galileo and the vertical integration as well. A positive quote from the analyst note that I found interesting, quote, "We view these businesses as the crown jewels within SoFi given their higher growth nature, 20% plus, lack of capital intensity, and the opportunities they provide to scale efficiently into new products or geographies." Overall, I think the note from Needham can be summarized by this direct quote. This is something that Peterson wrote in his report. Quote, "We view SoFi as a long-term winner in the digital lending neobank space, largely due to its focus on prime and super prime consumers and possession of a full banking license, which we believe provides the company superior unit economics compared to other consumer finance platforms that focus on lower income and or lack a banking license." So obviously very clear cut there in terms of what contributed to this $10 price target. Now, one day later, on Thursday, was the more interesting piece of news because we had the KBW analyst upgrade SoFi to a neutral rating. Now, this might not sound very exciting. KBW is still a very boutique firm, but you have to understand that KBW was the reason that SoFi dropped massively in January. And what I did was I dug up a post from January 2nd where the analyst Michael Perito lowered the price target from SoFi from $750 to $650, which sent the stock sliding down for some absolutely ridiculous reasons. I mean, one of the reasons was that the stock had run up too much and that had contributed to his rating. And not to mention that KBW had lower estimations for revenue and for EBITDA than even what the street had for SoFi. So we know that SoFi is going to come in above what the street has because we're reading between the lines in terms of what management is saying. KBW's estimates were even lower than that. So safe to say it was an overblown reaction for SoFi to drop 14% as a result of this analyst note. However, on April 4th, we had a note that SoFi was upgraded to market perform, and here Street Insider quoted this analyst Timothy Switzer at KBW. However, TipRanks was crediting this upgrade to the same analyst who gave us a downgrade in January, Michael Perito. The upgrade has a $7.50 price target. I don't really care who it was from KBW that upgraded it. I mean, one of the main reasons for this upgrade was that we're in a better position now from a debt perspective as a result of the issuance of the 2029 convertible notes. However, that's not even the main thing that I want to focus on, why they're upgrading and downgrading these stocks. This is not the most exciting thing in the world to be having a market perform rating. But in this context, Michael Perito is one of the biggest bearish analysts on SoFi. You have Giuliano Bologna, you have David Cavarini, and then you have Michael Perito. And so for this bearish analyst to turn bullish just 3 weeks before earnings, I think that's a positive sign from a sentiment perspective, if nothing else, right? Because in early January, this downgrade brought the stock down 14%, huge gap down on the chart. Today, on the upgrade, the stock was up about 1%. And so all of this in the course of 3 months, from January to now the beginning of April, the price target has not changed. It was at $750, dropped to $650, went up to $750 again. So it's kind of ridiculous the amount of power that these analysts have over a small cap company like SoFi, especially because many times these analysts have no idea what they're talking about. I mean, I posted this video earlier that I saw on Wednesday from Schwab Network, where this senior analyst was basically talking about SoFi, and he literally called Galileo Gemini.
SoFi, not necessarily in the fintech payment processing space. They do, of course, have a company called Gemini, which is a separate electronic payment processing company, but
totally confused them. He thought the bank charter was last year. He framed a couple of his responses in such a negative light. And I just think that there's such a higher hurdle for these analysts to fully learn about SoFi and all of the business segments that contribute to the business success, let alone for their ratings to matter in the grand scheme of things. Unfortunately, however, on a random boutique firm downgrade like KBW, the stock reaction is negative 14%. But 3 months later, when the same firm upgrades them, it's only up 1%. But the positive note here, if we read between the lines, is as we head into Q1 earnings, this is one of SoFi's biggest bears as I see it, now becoming neutral on the company. I think directionally this is a good sign because it shows to some degree capitulation on the negative arguments against SoFi's business and the prospects that they have coming up. And I believe that Q1 is going to provide further confirmation that this company is on track to not only be sustainably profitable this year for the remainder of the year, but to also crush Wall Street expectations on that profitability because of all the hints that management has dropped over the past several months. So time will tell. Obviously, this is a company that needs to execute to achieve these goals. And as they consistently do, these bearish arguments are going to fall apart. And many of these analysts are going to turn neutral as a result. Finally, on Friday, earlier today, non-farm payrolls came in stronger. And this is mixed by the market from a perception perspective. The reason this is mixed is because, on face value, the numbers being good is great for the economy because it means more people are working, fewer delinquencies, fewer people being unemployed as a result. So obviously this is good. It's also good for SoFi because their end of year guidance accounts for 5% unemployment. And so that number being lower is actually better because SoFi is being way too conservative. And it means that their estimations are going to do way better than expected because the macro environment is more favorable. But to contrast that, the reason why this could be perceived as negative is because it supports this higher for longer narrative. If the economy underlying is good and it's very strong, that there's no reason for the Fed to rush to cut rates, right? But regardless of that perception, it's all short term. I wouldn't look too far into it because here in SoFi, you have a company that's fundamentally executing on their business in whatever market environment they're placed in. We've seen them be successful in any market environment over the past several years. Today, I bought some 2026 calls at a $10 strike price. I think either way, as we head into earnings, SoFi tends to accelerate, so those might do well. But even if they don't, I have confidence going over the long term in the execution of the company. So we'll see how that goes. I'm sure we're going to talk about some of these topics a little bit later tonight on the SoFi Weekly podcast on this channel at 10 p.m. Eastern. So make sure to tune into that. Thank you so much for watching and subscribe for more SoFi content.